Breakthrough Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Hello, welcome to the COB this Tuesday afternoon. I'm Juliette Sarli. Great to have your company on a day when we started out quite solidly, but then we saw the sellers moving, quite a bit of jitters ahead of the US jobs data for both October and November, of course, coming through tonight. That had been delayed due to that government shutdown. A bit of weakness coming through in tech as well. Life 360 is at a 5-month low. IperionX also falling by more than 6%, weighing on the overall tech sector, which is down by about 2.6%. And in fact, there's only a couple of sectors higher today, industrials and consumer staples. So certainly a bit of a wobbly day today ahead of those non-farm payrolls. So a bit of NFP jitters. Also, pessimism persists. We had that consumer sentiment survey coming through for December. Now, November saw a tick up above that level of 100, which separates the pessimist from the optimist, or the optimist from the pessimist, I should say. And that was the first time we'd seen that since post-COVID. But it seems we're back in the doldrums, mainly because of the fact the RBA is likely done at cutting interest rates. Consumer sentiment falling 9% in December to a reading of 94.5 points, according to Westpac Melbourne Institute Consumer Sentiment Index. And then I mentioned a weakness in tech. So tech tanking after a similar loss that we saw on Wall Street. The Nasdaq was down 0.6%. Let's have a look at how our tech sector did. I mentioned Life 360 at a 5-month low, but some of the other players, WiseTech down around 3%, NextDC and Zip also weaker by around 3%. Energy stocks didn't do that well either today. We did see crude oil prices falling overnight, investors balancing these supply disruptions linked to these escalating tensions between the US and Venezuela, and some oversupply concerns as well, also the impact of the potential Russia-Ukraine peace deal. Santos there down 2.4%, Woodside down 2.6%. But industrials looked okay. That was one bright spot. Brambles, Reliance Worldwide there up 1.5%, Worley up 1.5%. Elsewhere, Qantas also positive today, up nearly 3%. It did return to court on the distribution of the remaining $40 million that the federal court has ordered it to pay as a penalty for outsourcing ground handling jobs. Seems the market is confident that will be dealt with. DroneShield doing very well, up 24%, winning a nearly $50 million contract through a European reseller. Southern Cross Electrical Engineering, that was our stock of the day. It's also secured some contracts totaling around $90 million. Poor old ASX though, it hit to an 8-year low. UBS cut its price target. There's all these concerns, of course, about the regulatory woes mounting as well. And look what happens when a CEO exits, perhaps. The Star Entertainment rising on a change at the top, up 2.4% to 11 cents. All right, let's welcome to the COB Martin Crabb from Shaw and Partners. And how did you view today's action?
A bit messy, yeah. As you mentioned, Juliette, we sort of started in a relatively optimistic mood. I mean, the SPI was off a little bit overnight, but not materially. We thought, this little Santa rally that we maybe are having, maybe you're not having, but it just got really, really sloppy as the day went on. And as you mentioned, anything that was US related or technology related got smoked. And I put that down to the price action of Zillow Group and CoStar, both two real estate portals in the US. Got very, very spooked on news that Google's looking to perhaps sell advertising space around housing and maybe eat into some of those platforms. Now, you speak to the analysts that cover the sector and they go, well, Google's been in and around here for ages, and it's not really the space that they're in. They're more dealing with agents than direct customers. You tend to go through agents to buy a house, right? Even though you're allowed legally to sell your own house, people that have tried it have basically said, no, you're much better off going through an agent. So I think these platforms are in reasonably good shape. However, like most things, it's like who's the EI genie gonna grab? And so anything remotely tech related, whether it was Life 360, Block was off, Xero was off, WiseTech was off, anything. Telix Pharmaceuticals, completely unrelated, but US based sort of stock. So a lot of weakness in those US names today, and just continue to drag the market lower. So we finished just off our lows, but also reflecting a weaker futures lead from both Nasdaq and E-mini futures were a little bit softer.
Yeah, as we await those non-farm payrolls. Now, when we look more broadly, you point out the year has been about small caps, not large caps, non-US versus US stocks. Really good chart you've provided us with this one. Let's talk through it about, what we've seen here and why is Australia at the bottom there?
Yeah. So Australian large cap stocks, I mean, basically you sit down and do an asset allocation at a really high level, Juliet. You'll go, am I local or global? So I do want my money in Australian stocks or global stocks. And generally most people have a view about whether the US is going to do better or the world's going to do better than Australia, And then within those regions you go, right, if I'm going global, am I going to the US, which is 70% of the world index, or am I going to the non-US? Now there's been a bit of debate that US has run very hard, it's now expensive, there's better value globally. And then domestically you look at, do I want to be in the banks and the miners and the supermarkets, or I am better off trying to find some small caps, and they do come in and out of vogue. So, the advice that Shaw and Partners had for most of this year has been small caps over large caps in the Aussie market, just we thought there was better value. Also, as the Australian economy improves and the dollar starts to move up, those small caps do well, and that's exactly what's happened. Small caps have done about more than 20% this year versus large caps less than 10, and emerging companies almost 30%. So if you go really into the micro end, there's been some crackers. You had DroneShield on there today. The thing's moved 25% in a day. So if you can find some of those exciting small micro cap stocks, you've done very well. Different story overseas though. Even though we talk a lot about the Mag 7 and we know how well it's performed, actually stocks outside the US have done a lot better. The US market's up about 7 or 8% this year, looking at the MSCI, whereas the MSCI World ex-US is more like 20. So again, if you'd not bought US stocks and not bought Aussie large caps, just bought smalls and global ex-US, you'd be up 20, not 10 this year. So it's been a significant difference between the two.
And also, if we look at your next chart, you provided the growth stocks here in Australia underperformed as well.
It's been terrible, and it happened again today. So again, this is the from the good people at MSCI who publish indices on value and growth stocks around the world, including in Australia. So they take their own index of 60 odd stocks and they classify all the stocks as either growth or value. So there's a few strange things, like I think they've got CommBank as a growth stock and and some growthier stocks as value stocks. It's a little bit odd, but it's a very consistent methodology that MSCI use in all markets, so it's good to compare them. But just again, if you pick the best performing part of that value and growth, again, it's outside the US and it's value stocks. So it's typically European or Asian stocks that are cheap or high dividend yield payers. They've done spectacularly well, up almost 30%. So you kind of think it's probably the most boring, lowly valued dividend yielding part of the market. It's done exceptionally well. Whereas the stocks that people typically try and chase, the growth stocks, the WiseTechs, the CSLs, these sorts of things, have done in Australia particularly poorly. Now that may reverse next year. I think there probably might be some reverse in some of that weakness, but this year's certainly been a time to avoid growth stocks in Australia and find value stocks outside the US.
All right, let's turn to what is in store from the RBA. We were talking about the RBA before we came on air. It very much seems like a hike now. I mean, I think CBA and NAB both saying they expect February a hike. Yeah,
look, it's really interesting how much this has changed. I mean, if we go pre-October, everyone was talking about rates going down to maybe 3.1, so 2 more cuts in 2026. And those of us with a mortgage had some smiles on our faces and probably a bit of a step in our stride because we're looking at lower interest rates. So the futures markets, it's moved towards having 2 cuts by the end of the year, or an increasing number of people going for 2 cuts by the end of the year. But the timing of that's really shifting. Now, it's a little bit jagged, that line, because not all the contracts are trading, but you can just see that the February and March numbers we're starting to look in about maybe a 1 in 3 chance of a hike in February. So the RBA doesn't meet in January. They're like most of us. They have a bit of a holiday. But they do come back and they will have some more data. They'll have some more inflation and unemployment data when they meet in February. So the market is now saying, and as you said, 2 major banks are now talking about a February rate hike. The thing is, Julia, if we get a weak labour force number, like we had the SEEK job ads out the other day and they were down. So if we get a really, really weak labour number, then maybe the RBA won't move in February. I think it's a little bit premature. And owning a mortgage, I hope they don't hike in February. If they do hike, maybe they can hike later in the year, but clearly the market's shifted its narrative on that quite dramatically.
Do you think maybe they're just going to hold for some time, but she's just using language and jawboning perhaps?
Yeah, I still think they're restrictive. I mean, my analysis, and I've done a lot of work on where the natural rate of interest is, and I think it's closer to 3 than 3.5. So I still think that will move back to, I think inflation will move back down, particularly as the dollar rises, because that's deflation, because we import a lot of stuff. And even though a lot of things have gone up, like school fees and petrol and that sort of stuff's gone up, I think there's a lot of deflationary forces in the economy. Immigration's come down, the dollar's going up. So I think inflation comes down, and I think they've got a really strong argument to stay at 3.5, 3.6 for a long period of time, with the potential that if something happens to the labour market and it weakens, they can cut easily. They can easily cut to 3.1, 3.35 from where they are.
It'd be really nice to just get nice to that good round number again, right? Too. Anyway.
Yeah, people talk about like a 15-point card. Yeah, we don't like these uneven numbers.
Now, just very briefly, do you think Santa's going to come before the 31st of December?
Yeah, I love a Santa rally. I mean, I think we've had a couple of big days of big sell-offs. I think we're due to climb a bit higher and finish the year on a good note.
All right, well, Martin, thank you. Actually, I think you're joining us for our last
come along
call.
Tomorrow.
Yeah, that's great. But as always, thanks for all your insights in the COB. Martin
Pleasure.
Crabb from Shaw and Partners. All right, well, we were talking about some of the stocks that were moving today, and the stock of the day was Southern Cross Electrical. Andrew spoke to our experts, Philip Pepe from Shaw and Partners, Rudy Philippek Van Dyke from FN Arena.
Whatever you think of the AI sector, whether it's in bubble or not, we are spending on data centres globally, we are spending on electrifications globally. We're trying to save on energy costs, and there are more efficient products available now than there have been. Someone needs to design them and install them. These guys are very well placed in that space. So they won $90 million worth of contracts today across data centres and the Sydney Metro. They're doing the comms for one of the, I think it's St Mary's station. There's more of that work to come. So for me, this is very much in the stronger for longer space.
And it's not just data centers. You see today as well, there's another contract for metro development. There should be more contracts around the corner. A lot is priced in here. As an investor, you have to realize now that you are on top of momentum here, positive momentum. You don't have maybe not much of a cushion of safety, as they say.
We all need a cushion of safety. Let's have a look at the leaders on a down day today. We touched on DroneShield there. What a rebound from a couple of weeks ago when it was absolutely hammered, up 24%, $2.84. IDP Education also looking good, along with Challenger, A2 Milk and Qantas. We touched on the reasons why, up 3% to $10.07. To the downside today, though, IperionX and Life 360. So this weakness coming through in US linked stocks, in tech stocks, Life 360 hitting a 5-month low. Also some weakness in some of the uranium, the coal players as well. HMC Capital down 4.5%. In the small end of town, CTI Logistics had a great day, up by some 19%. Hipages also doing well. To the downside though, in the small end of town, Antipa Minerals off almost 18%, and Jonathan Takadina's fave stock, Andy and Silver, giving a bit back, down 9%. All right, tonight it really is all about these non-farm payrolls data for both October and November. So we're trying to get a broad look of how the economy actually moved, and maybe net about 60,000 jobs. Retail sales also due for October, and the S&P Global PMIs as well. Tomorrow, we've got the Melbourne Institute Leading Index and an AGM for Dyno Nobel as well. But let's recap where the local market has finished the day's trade, and certainly being sold off ahead of the US session, down 0.4%. Weakness there coming through from the tech stocks that we touched on, but really it's hard to find sectoral winners today. Consumer staples up 0.2, industrials was where you saw the most strength, but Infotech down almost 3%, energy down 2.4%, and the ASX 200 has closed weaker by 36 points or 0.4%, dropping below 8,600 points, so 8,598.9 is where we sit. But you heard Martin Crabb, he thinks Santa will come, so maybe we're in for a bit of a rally. Let's see what those non-farm payrolls do and what they do to the US equity market. We'll be live again from 9:45 a.m. Eastern tomorrow. See you then.